Welcome back to Contemporary Math. We are in Chapter 4E. With this section, we're going to talk about income taxes. So this is the final chapter in Chapter 4, and so we will be taking a test soon. So they start off this thing, income tax basics. They start off with sort of how they're figuring out their taxes, and they start defining all their terms. So what we start out with is the gross income. That's all of your income for the year. Wages, tips, profits from business, interest, or dividends from investments, or any other income you can receive. So any way that you're taking money in, any money that you're receiving is going to go into your gross income. We're adding everything up. And so the first thing we do is we subtract adjustments to get to our adjusted gross income. So here it gives a list of some adjustments. So gross income minus adjustments such as contributions to individual retirement accounts, IRAs, or other, should say tax deferred. I don't know why it says TAC. It's tax deferred savings. Okay, then we take our adjusted gross income and we're going to take away deductions and exemptions is what comes next. And then after we take away any deductions and exemptions, so usually you get a personal deduction and you get deductions for anybody else that might be in your household, right? We will talk a little bit about the deductions, and you can either take like a standard deduction or an itemized deduction. There are, what was I going to say? So the deduction that we're talking about is either the standard deduction or the itemized deduction. The exemption is the thing that you get taken off per person in your household. So depending how many people are in your household, whether you take care of people or have kids, that's where the exemption thing is coming in. And so after we take off the deductions and exemptions, then we have the amount that we're actually going to like crunch some numbers on. So this is our taxable income. It's the thing that we're going to take to the table. We're going to do our elevated tax calculations on. We will be doing those later, but this is where we're going to be doing a lot of calculating based on a table. We're going to look at a table, grab rates from there. So we take that thing, we do the numbers with the table, do a lot of math, and then we subtract. After we do the crunching, we subtract tax credits. And so do I have tax credits in here? No. So those are something we'll talk about a little bit later. So those are like pretty special cases in which you get credits. There's not a lot of cases that give credits, but it's possible you might get some sort of tax credit. Maybe you run a business that gives you back tax credits or something. Then we go to our total tax, and so this is how much we owe. Or not, well, this, I guess this is what they say is the amount owed, right? So this is like how much you owed in tax. This is like how much you paid in tax. So when you get your paycheck, they withhold a certain amount. So this is like how much they're wanting. This is how much they already have. And so this is the final thing about how much you owe. So this is kind of like what you've already paid into it, the thing that comes off your check. Where am I at? Total tax, I think I talked about that. Taxable income is the thing that we actually take the calculation on. Total tax computation from the table minus any tax credits such as, that's right. Child tax credit is also another thing they take off. Tax refund, tax owed, the total tax minus any withholding by employer or estimated taxes. Total tax. So this is hopefully gives you sort of an overview about what we're going to do. We're going to add up everything that we're taking in. We're going to subtract a few things. We're going to do some calculations on a table. We're going to subtract a few more things after we do the calculation. And we're going to end up with how much we owe in taxes. So with this said, most people, they could probably figure out most people's taxes. If you run a business and you do other sorts of things, they get a little bit harder. Just depending how you get in your income, these things can be sort of drastically different, right? And you can fill out different forms. So we're going to go over like a sort of more general, how do we figure out the taxes sort of thing. From a very basic sort of like, he's earning something in wages, he's got this interest in the savings account. So this is like probably like what most people would have, something along these lines or something similar. If I'm being honest about taxes, I haven't done my taxes in like, I haven't done my taxes by hand in forever. I couldn't tell you the last time I ever did taxes by hand. I'm gonna go straight to TurboTax and go file it in TurboTax. Unless you have very specific things that you like need to do in your taxes, for the most part, they're kind of boilerplate. But with that said, there are, if you are into businesses and investing and all this sort of stuff, and you're doing a bunch of crazy stuff to make money like that, the tax code can be really, really, what do I want to say? It can be really complicated, and like people literally go and study, and they study the tax code to see what sort of write-offs people can get. And like, if you make enough money, if you're rich enough, right? Most people that make over a certain amount of money are paying someone to figure this stuff out for them. So like, it is a certain field in itself, and the tax code is extremely complicated and convoluted. And if you want to get into the really, really dirty specifics of it, there is a lot of sort of stuff in the tax code, and it's like a whole area of study on how to get around your taxes, basically, right? So people actually study how not to pay the taxes. So Aaron earned $48,500 in wages, received $685 in interest from a savings account, contributed $1,175 to a tax-deferred retirement plan. He was entitled to a personal exemption of $39,000 and a total deductions totaling $7,500. Find his gross income, adjusted gross income, and taxable income. So I know I spit a bunch out at you, so I'm going to start off with the gross income. So how am I finding his gross income? The gross income is everything that he's taking in. So that's the $48,500 in his wages, the $685 that he's earning, and $1,175. Ooh, no, that is not something he's taking in. That's something. So what I'm going to do is I'm going to add these two numbers to get his total gross income. Is what, 49,185? 49,185. Okay. If you have to refer back to this thing, you can totally go back and refer back to this thing. So we want to do gross income. The first thing we take off of there is adjustments. So adjustments are things like IRAs and tax deferred savings accounts. And so it says right here, $1,175 to a tax deferred savings account. So we're taking off that adjustment. So the next thing is adjusted gross income. And we're taking off 49,185. And we're taking off 175. If we take off 1,175, that should give us what? That's not correct. Sorry. Let me double check these numbers, make sure I'm getting them correct. Plus 685. 49,185 is correct. And then I want to take off 1,175 is going to give me 48. Now we're looking at this thing. I see you can go back look at that table on the first page, but I have adjusted gross income. The next thing they want to find is his taxable income. So if we're thinking about taxable income, I believe I'm taking off my exemptions and deductions at this point to get to my taxable income. Deductions and exemptions. So there should be a personal deduction and an exemption. So there's a personal exemption of $3,900. So I'm taking $4,800. I'm taking off $7,500. Okay, so that should give me 36. And this is my taxable income. So with that said, we're not going to the table just yet. But if I were to do this, this is the number that I would take to the table, and I would start multiplying it by the things in the table and all this good stuff that we'll go over in just a minute. Okay. And so there are 4 basic ways that you are allowed to file your taxes. So you get charged a different rate depending on how you file this thing. So if you're filing single, that means you're unmarried, divorced, or legally separated. Married filing jointly, or married filing separately. So if you're married, you have some options of how you and your spouse will file. If you file jointly, you're filing one return together. If you file separately, you're filing 2 separate tax returns. Another way you might be able to, if you are the head of household, so if you are taking care of other people and you are the primary earner, you are unmarried and paying more than half the cost of supporting a dependent or child parent, you can file as head of household. Okay, so exemptions and deductions. The standard deduction is a flat amount, so that will be in the table on the next page. But it is a flat amount. It is the same for everyone, depending how they file. So there is a flat amount standard deduction that you can take off your taxes. So that is one way to do the deduction. So you have a choice. You can either do standard or you can do itemized. You do one or the other. You're definitely not getting both of those off. You're getting one or the other. So standard is just a flat amount like you get from the table. The itemized deduction. So I personally have never made nearly enough to do an itemized deduction. And this is like with going to school and having expenses and stuff, it never added up. Like almost always your standard deduction is going to be more. I imagine people that run businesses might maybe get more out of an itemized deduction, but I have personally never benefited me personally. So I got to be a little bit skeptical of like, what are these people doing to get a itemized deduction high enough to where they're getting money off? But everyone's leading a different life. So let's look here. Your deductible expenditures are $3,700 for contributions to charity and $760 for state income taxes. Your filing status entitles you to a standard deduction of $6,100. How should you file? And so what is this talking about? You have a deductible. So they want to know whether we're filing itemized or standard. So I'm not sure. Itemized versus standard. So my standard is the 6,100. So if I take standard, this is the going to be $6,100. But if I do the itemized, I'm going to do $700 in contributions that I made to charity and $760 in my state income tax. That's 40. This is what I'm getting out of this. So I am still better going with the itemized or the standard deduction. So if you're filing this, you probably don't want to pay more in taxes than you should. You're probably going to take the $6,100 off. Okay, so now we're going to talk about tax rates. So in the U.S., we have what is called a progressive income tax. So people with higher taxable incomes pay a higher rate. There are reasons sort of why we do this. I know a lot of people kind of like try to press for flat taxes. I personally don't think flat taxes are a good idea. I've read a lot of sources and they tend to conclude that flat taxes are actually they would be a regressive tax. They would tax poor people more so of their disposable income, a higher percentage of their disposable income, than it would tax people with more money. And there's a lot of sort of factors within the reality that I think if you make more money, it seems kind of reasonable to tax you more. Because you have money, it's way easier to make more money, right? Sort of like we were experiencing with the previous examples. If I have $1 million, it's nothing for me to just go take out like 50K from that thing. It doesn't even leave that $1 million touched. I can leave that $1 million untouched and have like a 50K life, right? Just by having money in the bank. I can just skim off the money that I do have. Okay. So takes money to make money. So I think that kind of is part of the reasoning why we have this sort of elevated tax system. And also, like I said, if it was a flat tax, it would take a higher percentage of the disposable income of people that make less money, right? And so a lot of people will actually consider a flat tax to be a regressive tax because it tends to be harsher on people that make less money. So the marginal tax rate. So we have a progressive income tax system. So I went on a little rant there, but there we go. It's a progressive income tax system. What that means is that we have margins, or we have little brackets of like numbers that we fall into. And so everything from like 0 to 8925 is going to get taxed 10%. Is what this is telling me. So the marginal tax rate, or the margin, is referring to the bracket that it's in, right? So this is 0 to 8925. This is 8925 to 36250. Right, so we're putting these into different sort of brackets. One bracket sort of thing that's happening. We have 0 to 8925, right? We have like 8925 to 50. Right? Each one of these things is a bracket of numbers. We're taking the money that we make from here to here. This 10% bracket, I believe, is the bracket. That's the margin, right? That's what they're referring to as margins, is that we have these like range of numbers and they all get taxed sort of differently. Tax rates are assigned to particular income brackets or margins. For example, if you were filing single and your taxable income was 25K, under the 2013 plan, you would pay 10% for the first 8925 and 15% for the 16075. So what am I talking about here? Again, what we're assuming is that they're making 25K. So what's going to happen is we're going to take 10%. We want to talk about everything from 0 to 8925. And we're in the single column. So these are the other columns: the married filing jointly, married filing separately, head of household. They said he was single. I want to stay right here in the single column, and I want to look at my tax rate. So everything from 0 to 8925 is going to get taxed 10%. It might be kind of silly, but I'm going 8925. If I want to find out the range 0 to 8925, I have to subtract 0 from 8925. It seems really silly there, but I'm going to have a sort of pattern because I'm also doing 15%. But I don't re-tax this with 15%. This already got taxed the 10% rate. What this gets taxed is 15%, but it's only from the money from 8925 to 36250. Or we're not going up to 36250, sorry. One of the things you might notice when we started this off is he's got an income of 25,000. So I want to go over this and make sure we're all on the same sort of page here. So if he's getting 25,000 in income, and we're looking along here at the single column, we might notice it's going to fall right into this tax bracket. So we're going up, we're going to 25K, up to 8,000, we're past that. Up to 36,000, we're not past that. So the first 0 to 89.25 is going to tax 10%. And this problem, we're going from 89,250. We're not going to go all the way to here. We're going to go to the 25,000 that he's making. So we, in the final bracket that they're in, we do have to pull in whatever amount that they're making. We're not pulling in the end of the bracket, right? We're only going to the 25K that this guy is making. He's not making more than that. And then I have to subtract that first 8 that I've already taxed. And so what I'm doing is I'm taking 10% of this first, which is 89.25. It's not too hard to subtract. This one, if I do 25 minus 89.25, that's where definition up there. So the first 89.25 is going to tax 10%, and then the 16,075 that's happening after that, that marks it up to 25, is going to get taxed at 15%. And if we go 892.5, that to, what is this number here? 24,1125. If we add these two things, we get 3303. 95. Okay. So we have a few examples and a few tax rates to try to figure these things out with. Charlie single with no dependents, his adjusted gross income is 95,753. So they want us to use the tax rate, find the tax owed by each of the following people. Assume they all claim the standard deduction and neglect any tax credits. So he has an adjusted gross income of 95,753. So if we go back to that table on the first page, we've already made the adjustments to our income. The next thing we need to take off is exemptions and deductions. And so they tell me I'm taking off a standard deduction. He is single. So if I look over here at my table, I look at single standard deductions is 6,100. So I'm taking off deductions. I'm also taking off exemptions. He is single and has no dependents. So he is by himself. He is one person is what this thing is saying. So I'm going to take off 3,900. And luckily, like this is an even sort of figure. If we look at exemptions and deductions and we take off the standard, I believe we're going to take off what, 10K? So if we go 95,753, we're going to end up with 85. So this is his adjusted gross income. We're going to take off exemptions and deductions. We're going to end up with, this is his taxable. Okay, so this is the thing we want to tax. So we want to set up an equation to tax this thing. We're looking at this table. And so I'm looking for 85,753. So I'm looking along here. It's definitely in this one. It's definitely in this one. It does not go past this one. So I'm going to end with this bracket. So if you want to, maybe put a little tick mark, say I'm going to end with something. We're not going to go up to the 87,850 is what we're not going to do. We're going to go up to the 85,753. We're going to do that in the last one. So all the other ones, we're going to take the numbers and they're going to kind of come from the table. So what we're doing is we're going to do 10%. And it's silly, but I'm going to do it a few times just so we get the pattern down. I'm going to do 10% on the 8925 minus 0. The next thing, I want to do 15% on everything from 8925 to 36250. So now I'm doing everything 15% on everything that is from 36250. And I'm subtracting 8. The last bracket I'm making it in is 25% bracket. 25% bracket. This is the one I'm talking about. I don't want to go all the way up to 87, right? I want to go up to the 85. That's as much money as he's going to get taxed on. That's the taxable income. Now I'm subtracting this from that I left off of. So the previous number I left off of is this 36. So this is 10% on everything from 0 to 8925, 15% on 8925 to 36250. Then we're going to tax 25% on everything from 36250 to 85753. Okay. There are a few numbers we got to figure out. There are 3 numbers we got to figure out and add together. So subtract these and multiply them by 0.10. This is going to give me 892.5. If I subtract these 2 numbers and multiply it by 0.15, it gives me 409,875. Now I'm subtracting these 2 numbers, 85,753 minus 36,250, and I'm multiplying that by 0.25. 75.75. Let me see if I can zoom this out just a hair. Ooh, not like that. No, don't do that. Okay. So again, I'm good taxing these things based on the margin or tax bracket that I have. So I'm adding these 3 numbers together, doing a little bit of PEMDAS. I have to subtract before I multiply. So subtract those numbers before you multiply. You should get 3 different numbers. And if I add these 3 numbers together, it should give me 17,367. Okay. The next example. So we want to do this one. Denny is head of household, taking care of 2 dependent children. His adjusted gross income is 95,753. Oh man, did I make that the same amount? It is the same amount in all 3 of these problems. All right. Denny is the head of household. He's going to take care of 2 kids. So his taxable income is the first thing we want to find. So taxable income is going to be the 95,753. We want to take off. Does it say he's doing standard deduction? Oh, it says that in the setup, right? In this problem, it says assume they're doing the standard. So if we want to look back at that table, let's grab this table back. He is head of household. So we want to look under the head of household column. So he gets a standard deduction of $89.50. And the exemption per person is the same as in all of them. So I don't know if you might want to notice that, but the exemption per person is the same. You're going to get $3,900 for every person you have. So now we need to count the people that are in Danny's household. So there is Danny, and there are 2 children. Make this fatal mistake, right? There are 3 of them. Subtract 3,900 3 times, or you can subtract 3 times 3,900, right? Either way, you're going to take off the 3,900 3 different times. Don't make the fatal mistake of not counting yourself, right? You have 2 kids plus the individual. Okay, so we take 9573, 95,753, we subtract 3 times 3,900, and we subtract 89.50, sorry. That should give me 75,103. This is Danny's taxable income. So now we need to do a bit of math. Let's solve this thing out. We're doing our margins. We want to figure this thing out and plug it into the margins. But this time we're not going to look at the single. So we're looking at a different column now. We want to look at the head of household column. So these are different values depending which one you pick it from, right? Okay, so we want to do this. So we have 75,103 that we're going up to. So if we're looking along here, we're looking with 75,103. It is going to go past this one. It is going to go past this one, but it's not going to go past this one. So I want to stop here in this bracket. It looks like I'm going to have 3 different brackets I have to write out. And I don't want to ever write that 125 number, right? Okay, so we got 3 different brackets I'm writing out, the 10%. And so this number changes. It's now 12,750 household. But I'm doing 10% of the 12,750. I'm doing and this number gives me what? 48,600 is the number that I'm going up to. Left off on over here. I'm doing 25% of everything up to. Now I want to go up to the taxable amount, which is 75,103. I'm taking away what I left off with over here. 600 was my previous scrap. Okay, got 3 amounts I need to add together here. So subtracting this and multiplying should be hopefully pretty quick on that one. Should give you what, 1275, I believe. This thing I'm going to subtract those numbers and multiply by what, 0.15. Should give me 5377.5. And I subtract these 2 numbers, multiply by 0.25, and that should be giving me 6625.75. I'm adding these 3 numbers together, totaling them up to get 13,278.25. So that's the tax owed. Versus the previous one, which was what, 17,367. So this one is a bit less. Okay, so then so we get Caitlin and Rob are married. They are filing jointly. They have 95.73 in adjusted gross income. They each have that. So if we double that, we're going to get 191,506. So they're working together. I guess they have their own company and splitting everything 50-50 or something. I don't know how else they're getting exactly the same amount. But this is a scenario that exists in a math class, so it doesn't have to be perfect. We got 95.73 adjusted gross income. Total is 191,506. So this is the adjusted gross income combined. They are married with one dependent child. And they are going to take the standard deduction of married filing jointly. Married filing jointly is 12,200. So I want to take off my deduction of per person. So per person, it's going to be 3,900. So how many people are there? How many times are we going to take this 3,900 off? That's the next thing we need to ask. So you might see one dependent child, and then don't forget there's two people filing. So this is, you have to count yourself, and don't forget your wife or your husband this time, I guess, or your significant other, whatever they are. Don't forget the other one, right? There are 3 people total that we have to check off for. Okay, so this is my adjusted gross income minus my deductions and exemptions. When I take this off, I'm going to get 7,606. And so this is my taxable income. This is the thing I want to find the amount on. Okay. So now I want to go and I want to do my tax brackets. I want to look at married filing jointly, right up in here to married filing jointly. Okay, so everything up to 17,850 gets 10%, 72,500. I want to see where this 167,606 is going to fall into my married filing jointly. It looks like I'm going up here. I'm going 167 is going to go past 146. It looks like if I want to mark it, I'm going to end up in this bracket. So I do believe I'm going to end up needing 4 brackets for this guy, or 4 margin. All right, so we're looking along here, and let me set up these brackets. My taxable income is 167,606. So from everything to 0 to 17,8050. Is going to get taxed 10%. The next thing is everything from 17,850 to 72,500 is going to get taxed up to 15%. What's in the previous one? I got 1015. I need a 25% bracket. Is going to go from 72,500, and it's going to go up to, I'm looking at my table, 146,400. And the fourth number I'm looking for, the fourth margin that I'm trying to find in here, is I'm going to go from this up into my taxable amount. Oh, there it is, 167,606. And this is 28% bracket is what we're in now. So I'm going up to 167,606. And I'm doing that from this previous one I left off on was 146,400 was the previous bracket. Whew, okay, we got this thing set up. If you get this thing set up like this, these are my 4 margins. These are the 3 margins exactly as they are on the table. This is the 4th margin, goes from that number up to my taxable income. So I don't want to go up to the margin that's on the table for the last one, right? I want to go to my taxable income. So that's sort of a common mistake some people make. So this is the setup. I don't know why I threw an equals. We starting with this. And now I'm throwing an equal sign. I'm horrible about not putting my equal sign when I should, and now I'm putting them when I shouldn't. Okay, but here we go. We got this thing. If I want to do 17,850, subtract it from 0, multiplying it by 0.1 is going to give me 178. I'm doing 2 steps at once probably, but I'm subtracting this. I'm multiplying it by 0.15 is going to give me 8197. And $4. I'm going to subtract these two and then multiply it by 0.25 will give me 18475. And then the last one, I'm subtracting 167,606 minus 146,400 and multiplying it by 0.28 is going to give me 5937.68. And now I'm adding these 4 numbers together. If I add these 4 numbers together, 34, 35, 18. And so if we look and compare it to like maybe Charlie's and Danny's, this one is about twice as much as Charlie's. It's 2 people, so that we have the same income as him. So it's closer probably to Charlie's. I think it's 17,197.59 if we divide this into 2. It's a little less. Okay. But they also have a few kids too, huh? So there's a few factors in there that are making it. The amount it is. So we want to think about the next thing is credits versus deductions. So what I would really do is I'd like look back at this page. If you're filing and your taxable income was $25K, compare a $500 deduction to a $500 credit. And so if we take off a deduction of $500, we're going to take it off here, and then we're going to do our margin calculation. Versus if we take off a credit, this would be after we do our margin calculation. So if I think about his taxable income is $2,500. If I take off a $500 deduction, I'm going to end up taking $500, but after I do that, it's going to end up at $24,500. What's going to happen is instead of going, let's bring up this table again, everyone's favorite table. So does it say he's filing single? So if we're doing this, $24,500 is going to put him in the 15% bracket is what's going to happen. So 10% of the first 89.25 will probably, it should say -0. I'm going to drop it from now on probably. And what we're thinking is 500 minus 85, if we didn't take this off, right? So if we took it off, it would be 24,500. If we didn't take it off, our final bracket would look something like that. So we're thinking about what this is doing as a tax deduction. And if we do a tax deduction, it doesn't actually take a full $500 off our tax credit. It's only going to take 15% of that 500 is what we're going to end up taking off. We're getting the 500 and then we're going to multiply it by the 0.15, right? And so we're not actually getting the full 500. We're only getting 15% of the 500 off. So what this is telling me is that I'm getting $75 less in taxes. And you can crunch this if you really want to and compare those calculations. But if we compare this amount to this amount, there's going to be $75 difference between the two. Should be. If I did this right, hopefully. Definitely should be. Okay. And that's a deduction. So a tax deduction reduces your taxes by, this is going to be $5. But if we go back and look at our little table where we have the little arrows and stuff, back to this thing, if we look at credits, credits happen after we already do this elevated tax margin sort of thing. So they're happening directly to the amount of taxes that you owe. So if you get a $500 tax credit, hey, guess what? You're getting $500 off this thing, off your total taxes that you owe. So it's going to reduce your taxes by a total of $500. So as a rule, tax credits tend to be more valuable than deductions. We can take it off after we figure out our taxes. It's not going to get that percentage treatment. We get to take the whole thing off. If it's taking off before we do our taxes, we have to look what bracket we're in. And just to remind you, this is how we're getting that 75. We fell into the 15% bracket, so we're only going to be able to take off 15% of 500. So they talk about a mortgage interest deduction. So if you are paying for a home mortgage, that is one of the deductions that they allow you to take off. Okay. So suppose you're in the 25% tax bracket and you itemize your deductions. You're trying to decide whether to rent an apartment or buy a house. The apartment rents for $1,275 per month. If you buy a home, the monthly mortgage will be $1,500, of which $1,175 goes towards an interest during the first year. You want to compare your options. So this is going back to the comparing the credit or deduction. What are we talking about? This is a $1,175 goes towards this. These are deductions, right? Mortgages come out as deductions. So we are in the 25 tax bracket. If we're able to deduct it, right? This is our deduction. If we're able to deduct it by $1,175 and we're falling into the 25% tax bracket, then we're actually taking off, what is that? $293.75. So that's the discount that we're getting on our taxes. So if we want to know whether or not we're going to rent this thing, we're talking about a mortgage of 15 versus what? $1,275. So the real cost to this mortgage would actually be $1,500 minus $293.75. Real cost on the house would actually be $1,206.25. Take into account the money that you're getting back in your taxes. That's not correct. That should be, this should be divided by 12, I believe. I think I messed that up. No. I have it right in my notes. Right, sorry. I need to convert it, but I don't need to convert it because each month I'm paying this. Coming off of it each month I'm getting this much towards my deduction. I'm getting 25 of the $1,175 off of this thing. They do it like this in the book, and they have a few problems like this, and it's okay. If I'm being honest, and when I do my personal finances, like I'm going to treat taxes like there's some kind of bonus I didn't even know existed. Like I'm not going to account for that when I'm doing my budgeting. That's a little extra you get for just living. I don't know. I'd rather try to overpay my taxes and stuff like that and then get money back, right? I don't like having to pay extra in taxes when I figure them out. Howard is in the 15% marginal tax bracket. Kevin is in the 39.6% tax bracket. They each itemize their deductions. They each donate $1,000 to charity, which is a deductible, and we want to compare their true cost. So we have these two people that are coming from different brackets, different incomes, and we want to know the true cost of their donation. So if they're donating $1,000, Howard's going to be able to take off 15% of the what? $1,000. If I think about 15% of the $1,000, it's $150. So his true $1,000. He's able to take 150 off of that because of his taxes. $50 versus Kevin, so he's in the 39.6. So I want to find out what 39.6% of 1,000 is, which is $96. Kevin is going to be $1,000, and I take on $396. That's going to give me 604. And so we haven't really talked about people that might even be on the cusp, right? But there's also potentially you might be on the cusp, and like donating this money actually puts you into a lower tax bracket. So that's also a possibility that we kind of skim over that is not really said here. We're assuming they fall like flat in the middle, and it's not going to make a big difference on the tax bracket they're in, right? With that said, if we look at their sort of tax brackets, there's 39.6% tax bracket. Looks like the highest one they have on the table. If we think about them donating things, this guy is donating what, 850? This guy is donating what, 600? So when this guy donates $1,000, it's kind of like he's donating 250 more almost, right? It's costing him more to donate that than it would cost someone that has more money. So if you have more money, it's cheaper to donate your money. And so beware of those philanthropic billionaires, right? I guess is what I should say. If people are donating money, don't always just kind of assume it's from the good of their heart. There's a lot of reasons why people donate to charities, and it's not always because they agree with the charity. Sometimes it's to save some money on some taxes. Okay, FICA is the Federal Insurance Contribution Act. So this is what is paying for Social Security and Medicare. So they give us some basic sort of FICA examples, how to solve for FICA tax. So that it is 7.65 on the first 113,700 of income from wages. It's 7.65 that the employer matches. So both the employee and employer are paying into FICA. It's 1.45 income on anything over that. The employer also matches that. Individuals who are self-employed, you have to pay both portions of it. So if you an additional Medicare tax applies to taxpayers with adjusted gross income above 200K, and for individuals single or head of household above 250K for married. Okay, so what does it say? 3.8 on most income that is not otherwise what? Subjected to FICA, such as income from investments and dividends, 0.9% surcharge on ordinary income. Okay, so I am not trying to super complicate this FICA sort of thing. But in 2013, Mark earned $25,750 in wages and tips. Weighting tables calculate his FICA taxes and his total bill, including marginal taxes. What is the overall tax rate on his income? I assume he is single and takes the standard deduction. So going back, if we want to find FICA, we're finding FICA on his gross income, his adjusted gross income. So right here, we're looking at $25,750. believe should just be the sum up all the wages, tips, and this is on his income is 7.65 is 1969.88. So this is how much he's going to owe for FICA. Okay, so now we want to think about like marginal taxes. So the FICA, we kind of solve it separately from the marginal taxes. So if we take 25,750 exemptions and deductions. So if he's single, is that what it's saying? He's single and takes a standard deduction. What that means is he's got one exemption. He's got the deduction of 6,100. This, I believe, it takes off 10. So he's got 15. Is his taxable income. This is his taxable income. He's in the single bracket, so we're going 10%. And if we look at that single column, the first single column is 25. 10% on the first 89.25. We're doing 15%. Sorry, that was his income was 15,750. So we're not going past the 15% bracket. And if we calculate these things, 89,892.5 plus this over here, this should give us 1916. And so this is how much is owed. So he owes 1916.25, and he owes 1969.88. If we want to figure out his total taxes, plus 1916.25. If we combine his taxes, 1969.88 plus 1916.25, I should get 3886.13. Sorry, 3886.13 is how much he's paying in FICA and in income tax. So this is his FICA, income tax from the table, and this is all taxes. And this is all of his taxes. If we want to know his overall tax rate, tax overall, this is all of his taxes over all the money that he's making is 25,750. If we're looking at this, what percentage this is 15. So it should give you like 0.1509 if you divide those numbers. 3886. Should be around 15.9%, 0.09. Okay. And so capital gains. So if you buy and sell goods and you make money off of a business of such, your taxes get figured out a little differently. Or this is buying and selling stock. You can also get dividends and capital gains. So dividends and capital gains, there it is. Profits from the sale of stocks or other property. Short term is profits that are sold within 12 months of the purchase. Long term means they're held on for more than 12 months before you sell them. 2013 tax rates for long-term capital gains were 0% for income in the 10% and 15%. So we use the same sort of table. What they're telling me is instead of saying 10 and 15, I say 0. 15% for income in all tax brackets except for 20% for income in the higher bracket. Okay. In 2013, Tom was single and his income consisted solely of $80K in dividends and long-term gains. He had no adjustments to his gross income, but $20K in itemized deductions and took the personal exemption of $3,900. Determine his total taxes. So we got 2 more problems to go. And I'm not trying to make these super complicated, but if he's getting what, an income of $80K, and he's doing this in dividends and long-term gains. He has no adjustments to his gross income, but he has $20K in itemized deductions. So we can take off 20 the deductions, and we can take off the $3,900 for the exemption. And if we do that, we should be getting $56,100. And so now this is the thing we need to use our elevated taxes on. So we're looking here, he's filing, I believe, single is what it says. And we're looking for the 56. I think the 56 is going to fall right into here. So if you really wanted to write it, we're getting taxed 0%. We're going 8,925. We're actually going up to 36,250 is what we're going up to. We get taxed 0% here. We get taxed 0% here. We get taxed 15% on everything from 36,250 up until the 56,100, which is his taxable amount. So this is a difficult one. No, that's just 0. 0 times anything is just 0. So what we're actually doing is we're subtracting these two and taking 15% of them. This should give me 2977. Is what this should be giving. Okay, we're getting close. We got one more. Woo, tax deferred income. Tax deferred savings plan. So a tax deferred savings plan, you can put money into a savings plan. It's going to be tax deferred, a type of savings plan in which the money you deposit is not immediately taxed, such as an IRA, qualified retirement plans, or 401ks. Suppose you make 35K and make monthly payments of 122, a tax deferred savings plan. How does that affect your monthly take home pay? Okay, so I think what they're doing here, let's see that table. I think I'm assuming you're probably single. Maybe I'm making some assumptions. Okay, yeah. So if we go back here looking at our single tax bracket, I think any of them would probably work. But if we look at the single tax bracket, if we're making what, 35K, we're going past the 10%. We're going to go into the 15, but we're not going to go past the 15%. So we stop in the 15% tax bracket is what I'm saying. We're in the 15% tax rate. That's where we landed. That's our final tax bracket. So if we're making 35K in our monthly payment of 120, and it's a deferment. It's happening before the tax gets taken. How does it affect your take-home pay? Of the thing that we're talking about, another reduction in your taxes. For my take-home pay, what you're going to end up doing is you're going to end up depositing what, 102. It's going to take away $102 instead of 120 is what this is saying. $18 off your taxes, so it's like you're getting $18 back from this 20. It's $120. What are they? What's the word? They call it the. Make sure my vocabulary is the same and consistent. The true cost. That's what I'm looking for. So the 102 would be the true cost of this thing, is what the book says. Okay, so that is the final problem. I hope to see y'all soon. Take care and study hard.